Do you want to learn about the 4 best dividend ETFs? If you do, then you came to the right video because that is exactly what I'm going to be speaking about in this video. I'm going to be going over how these ETFs operate, kind of their holdings and their prior performance, and speak about their dividend as well. Now, me personally, I do own 3 of these dividend ETFs, so if I am suggesting it, then I am putting my money where my mouth is pretty much. Remember, if you do enjoy this content, give this video a like to get this content out there to a wider audience. It would be greatly appreciated, and also subscribe to keep up to date on future content. Getting right into it, the number 1 ETF on this list is VIG, the Vanguard Dividend Appreciation ETF. This is a great ETF. It is managed by Vanguard. For what this ETF offers, it has a very low expense ratio at 0.06%. So this ETF has an expense ratio that is in line with the lowest expense ratios out there. The investment methodology of this ETF is to track the performance of the S&P US Growers Index. And that index is designed to measure the performance of U.S. companies that have a history of increasing their dividends every year for at least 10 consecutive years, and then it excludes the top 25% highest yielding eligible companies from that index. So it's not going to include those very high yielding stocks like Verizon or AT&T. And then on top of that, these companies are generally going to have a consecutive dividend increase for the prior 10 years. The fund itself is very diversified, with the number of stocks being 337. So you are getting great diversification with a very good investment methodology overall. You're going to be invested in a variety of dividend stocks that not only have a good history of appreciating, but some of them do pay a decent yield as well. And just like the number of holdings, this ETF is diverse pretty well among industries, with information technology being the number 1 industry, but followed closely behind by financials, and then behind that is consumer staples. You're going to see a little bit more tilt toward a value-oriented investment methodology with this ETF compared to something like the S&P 500, which is going to have more information technology, because you want to have those dividend paying stocks, and that usually has industry in something like industrials and consumer staples and healthcare. So you definitely see healthcare at 16%, industrials at 12%, and consumer staples at 11%, which is generally going to be quite a bit higher than the S&P 500. And here you even have financials at 20%, which again is greater than the S&P 500 as well. The ETF provides a solid list of the top 10 holdings. I'm sure many of you have heard of these company names. You have Apple, Broadcom, Microsoft, JP Chase, United Healthcare, ExxonMobil, Visa, Procter & Gamble, Johnson & Johnson, and MasterCard. So again, you're getting that good tech mix in there, as well as those commonly known dividend-paying stocks like ExxonMobil, Johnson & Johnson, Procter & Gamble, and even JP Morgan. So again, a great mixture of stocks there. The dividend yield of this ETF is somewhat low at 1.71%. So this is primarily a dividend growth ETF, not a dividend yield ETF. And you really see that in the 5-year dividend growth rate sitting at a little bit over 10%. So really solid dividend growth all around. And then you, of course, see that consistency there of a 10-year history of paying dividends that are increasing. And over the past 10 years, you also see solid price appreciation, with the ETF being up a little bit over 150%. So you have great price appreciation, you have good dividend appreciation, and you have a good quality mixture of stocks. Great ETF overall, which is part of the reasons why I own this ETF, and in fact, it is the number 1 holding in my portfolio. I have a little bit over $40,000 of this ETF. So again, putting my money where my mouth is and really appreciating this ETF. Number 2 on the list is going to be the Schwab US Dividend Equity ETF, also known as SCHD. And I'm sure if you're a dividend investor, you know all about this ETF. The ETF has a total expense ratio right in line with VIG at 0.06%. And the intent of this ETF is to track the total return of the Dow Jones US Dividend 100 Index. And in my opinion, and I'm sure many dividend investors' opinions out there, this is probably one of the best dividend investment methodologies. This index is designed to measure the performance of high-yielding dividend stocks in the U.S. with a record of consistently paying dividends, then selected for fundamental strength relative to their peers, based on financial ratios. So unlike with VIG, where the investment methodology is very simple, pretty much just filters out companies with a history of paying consistent dividends that increase over 10 years. This further filters those stocks using financial ratios to pick the best of that group. And as the name suggests, this ETF holds around 100 stocks. So there's 103 companies, so there is a little bit of a tracking difference there. And your fund rebalances every 3 months or so to recategorize its holdings. So you're not always going to have the same holdings in this ETF. This ETF is going to constantly shift around its holdings to pick those great dividend stocks based on those fundamental ratios. Speaking of the dividend yield is, of course, as expected, a bit higher than VIG. So the 30-day yield is sitting at 3.62%, which is more than double VIG because, again, this ETF picks higher dividend yielding stocks. So if you're looking for dividend yield and income more so than dividend growth, then this might be an ETF for you, but I'm going to get into how this dividend growth works, and you'll see that it is extremely good too. Top 10 holdings here, we have Lockheed Martin, BlackRock, AbbVie, Home Depot, Coca-Cola, Cisco, Amgen, Bristol-Myers Squibb, Verizon, and Texas Instruments. So you have some really good diversification there of some really well-established companies. And this ETF kind of breaks down pretty well based on industry as well. Looking at the industry breakdown of this ETF, you're going to see a big move away from information technology, unlike VIG. So information technology accounts for less than 9% of the total holdings. When you have more higher yielding dividend industries coming out on top, like financials, healthcare, consumer staples, and industrials. And of course, energy is there as well, over 10%, with all the other industries falling below 10%. So this really is going to be an ETF that is focused on those higher yielding dividend companies and a bit of separate industry diversification than something like the S&P 500 or VIG. So I was speaking about the dividend before, and again, a dividend yield at 3.37%, which is higher than VIG, and the 5-year dividend growth rate is almost at 13% with a dividend growth history of 12 years. So as far as dividend growth goes, it outpaces VIG both in the dividend growth consistency over 12 years and also the dividend growth rate. So you may be wondering, if you are a dividend investor, should you pick this ETF over VIG? And if you are strictly a dividend investor, I would say you should. But let's look at price appreciation as well. And looking at price appreciation, you see that this ETF is up only 117% over the past 10 years. And I say that as kind of jokingly because for what this ETF offers in dividends, for it to appreciate 117% over the past 10 years, it is very, very good. And of course, it underperforms VIG in that category, with VIG being up around 153% over the past 10 years. SCHD definitely outperforms in the dividend category, again, with a higher yield, higher dividend growth rate, and also a longer history of consistently increasing dividends over time. Now, also another factor here is you can always reinvest those dividends, and the total return of this ETF will also go up. But the total return with those dividends reinvested of VIG will also go up as well. The main difference with these two ETFs is that VIG is really centered to a more price appreciation investment methodology than SCHD. SCHD is designed to, of course, pay higher yielding dividends and to even grow that dividend faster. But VIG has some more growth holdings in there that allow the price to appreciate more. So either way, great ETFs, but there's kind of a distinction in between investment methodologies, and whether or not you want to hold this ETF or the other ETF kind of comes down to, do you want more growth or do you want a higher dividend? Number 3 on the list, we have the pretty popular iShares Core Dividend Growth ETF, DGRO. Now, this is a very popular ETF among dividend investors as well, but it's not so much as popular as VIG or SCHD. Overall, though, very solid ETF. It does have an investment methodology somewhat similar to VIG. So this investment methodology is to seek a return of an index composed of US equities with the history of consistently growing dividends over time. I like to classify this ETF as a mixture between VIG and SCHD. This ETF does have a slightly higher expense ratio than VIG and SCHD, coming in at 0.08%, but not a big difference overall. Now, as this list goes, this is going to have the greatest diversification among companies at the total number of holdings at 412, with a 30-day SEC yield of 2.25%. So again, it is higher than VIG, but not as high as SCHD. Kind of a good blend here between the two. Looking at the top 10, as I said, it's kind of a blend between VIG and SCHD. So you're going to see the top 10 pretty much consist of holdings that both of the other two ETFs have, with Johnson & Johnson, JP Morgan Chase, AbbVie, ExxonMobil, Apple, Microsoft, Chevron, Broadcom, Procter & Gamble, and Home Depot. Again, overall, quality top 10. And again, I think that this is a perfect blend. So if you're looking for an ETF maybe with not as high as a dividend as SCHD with good capital appreciation, this might be a good ETF for you. Looking at the industry breakdown, again, you definitely see that mixture of SCHD and VIG that I was talking about. So this ETF does have a slant to the top with those practical dividend paying industries like financials and healthcare, and also industrials and consumer staples. But if you remember how information technology in SCHD was under 10%, this ETF does have information technology weighted at a little bit over 16%. So again, this ETF is pretty much a blend between the other two. Looking at this ETF though, it does come up short with the 5-year dividend growth rate. So the 5-year dividend growth rate is 9.3%, which comes up short compared to both SCHD and VIG. So you're not really going to see an average dividend growth rate here that is better than the other two. Nonetheless, pretty solid overall. This ETF offers some pretty good price appreciation over those 10 years, with it being up almost 147%. Still lags VIG a little bit, but it does appreciate higher than SCHD over that time. Again, with those dividends reinvested, all of the total returns of these ETFs may come up a little bit different. But the important thing to note here is that if you are using those dividends and taking them out to spend or to put towards something else, then these ETFs just have a capital appreciation of what is on this chart here. Still a solid ETF, and again, it does kind of blend SCHD and VIG together. And this final dividend ETF here is for those dividend yield lovers. This is JEPI, the JP Morgan Equity Premium Income ETF. It is an extremely popular dividend ETF among dividend investors because of its high dividend yield and because it also pays dividends monthly. This ETF also has the highest expense ratio among the ETFs, sitting at 0.35%, but I don't think it is too bad considering how this ETF operates and what you get from it. The 30-day SEC yield is 7.76%, so the highest on this list of dividend ETFs. And the way this ETF operates is a little bit different. So I'm going to get into the number of holdings first and also the industry breakdown. Before I get into the investment methodology, the number of holdings of this ETF is 131, so it is pretty diversified overall. And you do see some holdings that are not typical of regular ETFs here. So you have a top 10 of Progressive, Train Technologies, Meta, Southern Co., MasterCard, AbbVie, Amazon, Microsoft, ServiceNow, and Lowe's. So you are not going to only see dividend paying companies in this ETF, and that is partly because of its investment methodology. You're going to see some overall all around good industry diversification, and that is partially because the way this ETF operates, they really try to reduce volatility and try to get this ETF in as many sectors as possible. All right, so how does this ETF operate? As I said, it's a bit unconventional compared to the other dividend ETFs on this list. It generates income through a combination of selling options and investing in US large cap stocks, seeking to deliver monthly income from associated option premiums and stock dividends. So it also constructs a diversified, low volatility equity portfolio through proprietary research process designed to identify over and undervalued stocks with attractive risk-adjusted return characteristics, and it also seeks to deliver a significant portion of the returns of the S&P 500 with less volatility in addition to monthly income. So as the investment methodology suggests, you are not only getting dividends from the stocks that this ETF holds, you're also getting a significant portion, in fact, the largest portion, from options premium. And higher volatility environments have allowed for more options premium potential, while lower volatility environments may deliver less options premium. And this is an important distinction because basically what this means is that your dividend payment is not always going to be the same or even consistent or predictable. Kind of a quick example, if you look in this cash amount column of when these dividends were paid out, you see a constantly changing dividend payment. And again, this really isn't too predictable. It basically depends on market volatility, and sometimes you can get paid a very high dividend, or sometimes you can get paid a pretty low dividend as well. So again, don't always expect a massive dividend, but you can kind of expect the dividend yield to usually be over 5 to 6% on average. Now I want to show you all this because it again is an important distinction compared to the other ETFs on this list. There really is no defined dividend growth rate because it does pay that income from options premium. So there's sometimes month to month this ETF can pay a high dividend. There's some months when it can pay a somewhat lower dividend. Again though, you should expect a dividend about in the range of over 5 to 6% annually. So again, don't really look at this ETF for dividend growth. Look at it purely for dividend yield. This ETF hasn't been around for 10 years, so there's really no metric to compare this to, but you can see that it did go up and then it did drop in value. This is not going to be a capital appreciation ETF. The intent of this ETF, again, is to pay higher current income rather than it is price appreciation. So maybe for a lot of people, the good thing about this ETF would be to invest in when you already have a large amount of capital to invest, and maybe not so much thinking about growth. Now this will change a bit with those dividends reinvested, so the total return will look a little bit different than that chart, but just keep that in mind that the underlying capital of this ETF isn't designed to really appreciate compared to a conventional ETF. So I just showed you some of the best dividend ETFs out there. And again, I do own 3 of them. I own VIG, SCHD, and JEPI. Not so much DGRO, but again, DGRO is pretty much a combination of VIG and SCHD. So it's not like I'm going to be getting any other greater diversification if I decide to invest in that ETF. And I like showing this to you and speaking about these ETFs because, again, I'm kind of the person that puts their money where their mouth is. And I just don't want to be telling you about all these different dividend ETFs out there, like something like YieldMax or QYLD, which generate high amount of yield, but I don't invest in it because I don't believe in the investment methodology. So I really hope that you use these ETFs as an example. Maybe you do own some of these ETFs already. Maybe you're a new investor looking for some dividend ETFs to invest in. Nonetheless, I hope this video did help you out to pick a selection or get some information. Remember, if you did enjoy this content, leave this video a like. It'll be greatly appreciated. It'll help this video get out there to a wider audience. And also subscribe to keep up to date on future content.